Hello, this is Josh Belk with the Belk on Business podcast. I wasn't even considering doing this, but I've had a number of emails, text messages, and quite a bit of other communication come my way in regards to putting some information out there in regards to the proposed tax changes. Of course, as I think everyone knows, we just had an administration change in the White House, and during the campaign cycle and leading up to the election, now President Biden had thrown quite a bit out there in regards to proposed tax changes. As a tax professional, own an accounting firm, of course, we kind of live in this space, especially since tax is the area that we spend a great deal of our time focusing on, especially working on tax strategy and planning with our clients. And so we really kind of try to stay on top of these types of matters. And I generally don't like to spend a whole lot of time talking about speculation, but really kind of working through the situation that we are definitely facing. And but I think that since I have received so much in the way of requests to kind of address this, I'm going to quickly kind of blow through this. And of course, we could spend much time in discussing this. And hopefully you do have these conversations and you have an accountant that's kind of staying on top of these matters and will work with you in regards to tax planning. Especially as we see the environment change from one under President Trump, who really believed that a lower tax strategy was better overall for the country, and now we have a different paradigm. So we have a president that, in some ways, feels like he wants to punish those who have achieved some wealth. And you have to realize that our tax code is not something you should look at as being fair, but the tax code really is there to do things. First of all, of course, is to raise money for the Treasury, but secondly is to get all of us as consumers, and especially and also those of us who are business owners, to act in a certain way. So tax is not good, is not bad by itself. It is something that is essentially, it's morally neutral, okay? But sometimes the onus behind, or the emphasis behind the way that rules get made, sometimes politicians will want to step in and almost make it a moral type of a situation, aka punishing those who may act contrary to the way that they want you to act, or those who happen to have achieved some modicum of wealth. Now, for most of the requests that I'm receiving, most of the rules that are there are not going to apply to them. So President Biden has really tried to make it clear during the election cycle that everything that he is proposing and other Democrats are proposing are really meant for those who are making over $400,000 a year. And as we kind of go through and read some of these proposals, although there's a lot that's unclear, and my guess is that most of this will probably never see the light of day, or if it does, will be drastically changed by the time it's eventually passed into law. But I do want to kind of just run through a little bit of what has been proposed, kind of give you just a primer of some of it, and then just to get your wheels turning a little bit mentally as far as on what are some areas that may apply to me, and what are some conversations that I should be having with my tax professional as we work our way through the year, and hopefully as they and maybe you kind of keep an eye on what ends up in Finance Committee, or what ends up being introduced into either the House or the Senate as it relates to tax law changes. So first of all, let me get into the individual side. So some of these proposals on the individual side. First of all, with the individual tax rate, that top rate being increased. The Tax Cut and Jobs Act, which Congress passed at the end of 2017, went into effect in January 1st of 2018, lowered all the tax rates. And it lowered that top tax rate down to about 2.6%. And what's going to happen, anybody over the 400,000 threshold, they will see that top rate increase. So right there would be a 2.6% tax increase on any individual making over $400,000 a year. And so you add that in with the net investment tax, which is like the Medicare tax, that 3.8% would make overall that effective tax rate at 43.4%. Secondly is the increased capital gains tax rate, which is, I think, more than any other area, one that is I've worked with many of our clients and with other tax professionals in my space. It's been, I think, has garnered the most conversation. And so removing essentially the low capital gains rate, which is now at 0, 15, or 20%, and for any individual that makes over $1 million a year, to remove that 20% rate, and it would end up being taxed at ordinary income tax rates, or essentially at a 39.6% rate. And also the question becomes, as far as the net investment tax of the 3.8%, if that also would come into play. So if you're under that threshold, at least what's being proposed, if you're under that $1 million in income, you're not going to be affected by this. Now, we don't know if he'll lower that, if he'll go down to the 400,000, or if he may do something differently. But as of at least right now, what's being thrown out there, it is $1 million in income. Next, repeal the $10,000 cap on the state and local income tax deduction. This is something that was put into place by President Trump and Congress, essentially to punish those states that are those who lived in states with high income tax rates. And so this is probably something good that is being considered, and that's removing that SALT deduction, that state and local income tax deduction, which is capped at $10,000, removing that and allowing for individuals to be able to deduct more than $10,000. Next would be when somebody passes away, that becomes the taxable event. So death is a realization or a taxable event. So normally when someone passes away, the property that gets passed down receives a stepped-up basis, either at the time of death or a 6-month evaluation date. So 6 months after death, whatever the value is, fair market value as of that point. So you can choose one date or the other, and you would get a stepped-up basis. And so what the proposal, what would happen here is that when someone passes away, there would not be that stepped-up basis. And even worse than that is that at death, essentially whatever the unrealized change is. So I'll give you an example. So mom and dad go and they had bought a house for $20,000 many years ago. The last or surviving spouse passes away, and you as a child end up inheriting a property that they bought for $20,000, and now it's worth $100,000. Okay, that $80,000 you would have to essentially pay tax on the appreciation of that asset, whether or not you sold it. Okay, and so that would end up being, I think, something that would be extremely difficult for people to digest. So they're dealing with the death of a loved one. Now all of a sudden they have a taxable event that they have to worry about and they have to deal with. So that's something that really you'll want, that can affect or could affect anyone regardless of their income level. Next would be a limitation on itemized deductions. So on one hand, removing the SALT deduction, but for anyone who makes over $400,000 a year, that they would essentially be able to only deduct the itemized deduction at a 28% rate and not at the 39.6% rate. And so the effectiveness of itemized deductions wouldn't be as great, and also a reinstitution of the Pease amendment, or the Pease limitation, which I'm not going to get into, is way outside the scope of this podcast, but it is kind of a phase out as well. Next will be a phase out of the pass-through deduction, or the QBI deduction. So as part of the Tax Cut and Jobs Act was a QBI deduction, which essentially for pass-through entities for basically non-professional services companies out there, they would be able to deduct 20% of the essentially of the net income or the taxable income that their entities ended up making. So a company, for example, that if you have a pass-through entity, it made $500,000, that you would be able to only pay tax essentially on 80% of that. Okay, I'm oversimplifying it. There are a couple other factors that go into play there, but what would happen here would be a phase out. So once somebody makes $400,000 a year, there would be a phase out across all income categories as it relates to the QBI deduction. So this is, and then the payroll tax. So the payroll tax right now in 2021, you pay the full payroll tax. And for those of you who may not understand what that is, the payroll tax, and if you kind of look at your pay stub, essentially your employer withholds 7.65% out of your check, part of his Social Security, part of his Medicare, and then the company matches it. And that ends in 2021 at $142,800. So if you make more than that, the Social Security portion drops off and you only pay the Medicare portion. And the same thing with the employer matching. And so what this proposal would do is that it would stop at the 142.8. However, it would pick back up again at the $400,000 threshold. And so you kind of end up what they're calling a donut hole. So the difference between the 142.8 and the 400,000, you would not pay the additional Social Security tax. But once you hit the $400,000 threshold, it would kick back in. And so that's what's being proposed. And for somebody out there who has who's a sole proprietor or a single member LLC, a tax as a disregarded entity, for them, they essentially would feel the full impact. They would not be kind of that donut hole. They would feel the full impact if they were over the $400,000 level. So definitely some tax planning that will need to come into place with all of this. But but as it relates to how you're getting paid from your company, how your companies are structured, these are things you're going to want to consider. I'm going to just really briefly talk about the corporate side, because not a whole lot of small businesses are C corporations, but you maybe kind of need to be aware that there are some changes. So if it's a higher income company, and there are going to be some additional taxes that are going to be implemented at a basic level. The proposal is to increase the limit that for C corporations that had dropped down to 21% for that to go up to 28%. Now it's not as high as it was before prior to the Tax Cut and Jobs Act, but there would be an increase. And beyond that, there would be other taxes based on how much gross revenue you have, whether or not you offshored some of your production and then brought it back from overseas back here. There'd be kind of a penalization there. There are some credits being proposed as it relates to kind of a made in America type of a credit. And so so if you do operate a C corporation, especially one that generates a lot of revenue, you're really going to want to get to work, especially if these proposals begin to see some traction. There would be he has proposed a repeal of like-kind exchanges or 1031 exchanges, okay, which essentially would allow for you to, if you have a long-term held asset, so say, for example, you had a multifamily property, you've held it for a number of years, you can go ahead and do a like-kind exchange and purchase another multifamily property, for example, and essentially the capital gains would roll into that next property, so you would not have to pay taxes. So that would eliminate it. So if you were to go into to sell a piece of real property that you've held for a long period of time, at that point you would not be able to do a like-kind exchange. The other one that I've received quite a few questions on is essentially is a taxation of unrealized capital gains or unrealized gains. And this is not something directly by President Biden, but by a couple others. And just to kind of be aware of this. And once again, it would only affect somebody over the $1 million mark, $1 million in income, or $10 million in essentially net worth. And there's some exclusions in regards to primary and secondary residences and retirement accounts, and can be confusing. But if you're an individual with over $1 million in income, it's something you're going to want to be aware of. Now, I can't imagine that this one will see the light of day, and I have a feeling it would also face quite a bit in the way of legal challenges. But essentially what this says is it's a mark-to-market approach to taxation. So every year, if you make over $1 million, every year they're going to take a look at assets that you had not sold. So maybe appreciation in your stock portfolio, for example, over the course of that year, that you would have to pay income tax on that appreciation, whether or not you had actually sold any of that stock. And so just quite a bit here in regards to what has been proposed. Once again, if you're not at the $400,000 level, there's not a whole lot here that you need to worry about unless you are affected in some of these other areas. For example, if you do hold real property and you're considering doing a like-kind exchange, or if you have a business that you're looking to sell and it would put you over the $1 million in income. Okay, so these are things that you'll definitely want to be aware of and really begin to have that conversation with your accountant in regards to tax planning as we move throughout this year. If you think that you're going to end up falling under some of these proposed tax changes that are out there. Hopefully this brought you some value, and would encourage you to subscribe to the Belk on Business podcast if you haven't already. Have a wonderful day.